So how to leverage your assets like a pro to skyrocket your property investing or property developing career. That's the subject of today's Property Answers, and I'm joined by my only good friend, John Howard. John, good to have you today.
It's amazing, as property developers, investors don't have many friends, do we? Really,
not many. Not many.
It's difficult, isn't it? When you've got to admit I'm a friend is a bit sad, really. But anyway, there we go. Yes, delighted to be here, Ranjan, and a very serious subject today.
Absolutely.
And one that you've got to be really, really careful with, in my view.
Let's just define a few terms. I mean, we talk about leverage assets. I think we should talk about what is leverage and what sort of assets are we talking about leveraging.
Yeah. Well, leverage is really what property investment and developing is all about.
Without leverage, there's no point.
Well, unless you've got a hell of a lot of money to start with, and even then, you still probably want to leverage it. And when we say leverage, what we're talking about is borrowing money against assets and getting them revalued, and then borrowing more against the same assets.
Yes. Yes.
Now, that's become more difficult over the last few years because interest rates have gone up and so on. And there are times when you don't want to leverage too much. And there are other times when I believe you need to put your foot down on the accelerator and leverage more.
Yes.
And that's when the market starts to rise. At the moment, it isn't rising. And I think you need to be very careful about how much leverage you want. And don't forget, some of these banks potentially will throw money at you to leverage because they want to lend the money.
Yes.
But it's not always the best thing to do in certain circumstances.
I think you made several good points. I mean, I think the first thing that I've always say to people is just because the banks want you to, are happy to lend the money, it doesn't mean it's good for you to take it. Although all they have done is checked that they will not come out at a loss if everything went sour. But that doesn't mean that that will work for you. That's very, very important. And the other thing you said about leverage was about timing the market, the times to put your foot on the gas and what have you. Do you think also there's any linkage between which decade you are in life?
I don't know what you're trying to say there, Ranjan.
No, I say this.
Are you trying to be rude?
I say this because I remember when I was in my 20s.
Yeah.
I had lunch with a relationship manager. He was actually from Coutts, and he was retiring.
Yes.
And he told me that in every decade, he's seen the most successful investors, that in every decade of their life, they dial down the amount they're willing to leverage.
That's interesting.
So the 70-year-olds he's seeing are 30%.
Yeah.
But because I was in my 20s, that's the time when it's really, really high. And it's keeping it, dialing it down in each
I think there's
decade of life.
three things there. One, my Coutts relationship manager hasn't had lunch with me for 3 years, which does annoy me.
I don't do that anymore.
That's the first
I haven't
thing.
had that for a long time.
And that's in the Strand, by the way, the restaurant in the Strand, which is lovely. The second thing is, I think you've got a good point there. It depends where you are in your life, really. So in your 20s, you're probably going to be more ballsy because you've got less risk.
Yes. More time to make up.
Yeah, more time to make up. But also you've got less knowledge, and you're probably going to be more ballsy because little knowledge is dangerous.
Yes.
And when I look back, I suppose I was more ballsy and probably made more money actually in my 20s than I have done since pro rata, because the market was going up. And we were able to borrow quite large sums of money, at a really good backer, and so on. So you're probably right. And as you get older, you don't want to lose what you've made.
Yes.
The humiliation of it all. You imagine you've got a very lovely lifestyle, Ranjan. Imagine losing all that. It's quite mentally, as well as anything, it would be a terrible thing. I'd have to buy lunch because you couldn't afford it, which actually I do buy lunch now, so I don't know what's happening. I hope you're not in any trouble, Ranjan.
I don't remember the last time you bought lunch.
Well,
but anyway.
I can. But no, seriously, what I'm saying is you're absolutely right. As you get older, naturally you probably take less risks. And you've probably got more money as well, so you probably need to take less risks as well. So I would agree with that. But I still believe there are times when you know, to leverage and put your foot down, and other times when you shouldn't. And you know, I've got a prime example at the moment where we've got a property where we bought, I think it was 14 flats in a country house, and we're selling half of them and keeping half. So we've nearly sold the half now, or developed the half. The other half we're keeping. We've had it all revalued, and we're getting our cash back that we put in, and we've got the half of them virtually for nothing. And that is good leverage at any time. That's good leverage because we've got income coming in to cover the loans we're putting on them. And that's good leverage, and we're moving on to the next deal. Now, to me, that's sensible leverage. Where it's not so sensible this time, maybe on a development where you're trying to borrow too much money because whatever situation you're in, you've had to borrow more than you wanted to. Interest rates are very high. It's taken longer than you want, and we've all been in this situation. That is not good leverage. And in fact, in certain times, what we've done, we've reduced our lending, our borrowing. We've reduced it because we've had cash available, and we haven't found any deals to do because it's tough and there weren't many deals to do. We've actually used that money to reduce our borrowings rather than the other way around. So it really is all about timing and when to do it. And I don't think this is the time to do it particularly.
Do you look at leverage on a property by property basis or as an overall portfolio basis?
That's very interesting. I would say, an example I've given you near Birmingham, the country house we've done, I would say actually we do it on a property by property basis depending on the market. And like you said, there's safe leverage and there's risky leverage. And I don't think we should be doing risky leverage at the moment. Yes, there are times when you should, when the market is going up, and you can probably borrow as much as you can because you know it's on the up. But we're not at that stage at the moment.
Interesting. I mean, I look at it as a portfolio basis because I look at it as this is our target level of loan to values across the board, which is just short of 50%. That's a level I feel comfortable at. But there are properties that are 75% loan to value.
Oh,
and there are some that are nothing, but it's across the portfolio. So a typical example of that will be a commercial property that might be unencumbered, and a residential buy-to-let that's 75%, simply because the loan rate is far better on that. And also the buy-to-let loan is a different type of loan than a commercial loan.
Totally.
It's 25, 35 year, they can't call it in and all of that. So there's some power in looking at leverage on a portfolio basis as opposed to individual property by
property. But let me give you an example of where that can go wrong. So if you're 75% loan to value in a tough market, or the market gets tougher, and you don't have it, if you have it a long period of time, the loan, that's fine.
Fixed rates,
But if you haven't, and you've got it over a 5-year period, 5-year period comes up, it's revalued, the market has gone down, and people think, oh, the market never goes down. Well, it does go down. We all know it does, or we should know it does. And you were borrowing 100,000, and now on an up-to-date valuation, you could only borrow 75,000 on their criteria, or their banking mandate might have changed. It might have gone down, so they might have lent 75% loan to value, but now they're only lending 65%. Then that person can be what we call underwater.
You're absolutely correct.
And you've got to find the cash to put into it to keep it going.
You're absolutely correct. But as I said, if you look at it on a portfolio basis, there's still a lot of cushion. But we had a previous episode on bridging, and we talked about looking up bridging lenders. In the same way, I think mortgage lenders are slightly different. And some of the better ones that, say, offer you a 5-year fixed rate term, I think when you're dealing with a buy-to-let mortgage, you've got to look at, well, when you come off the fixed rate, what are your what's the process for opting in to another one? And the ones I favour are the ones where they say, you know what, you can opt into one of our products, there's no fee or whatever, or there's a fixed fee, and it's simply done on a desktop model
Totally.
valuation, AVM type of valuation,
but
and it's simple.
But even then, even that can be dangerous because, you know, if it isn't on a long-term basis, and I've had it myself, and you've had it, I'm sure, over the years, where, you know, the market has gone down and suddenly you thought you were at 60% loan to value and suddenly you're at 80% because it's worth less.
No, but in that scenario, yes, if it happens, because you've got unencumbered, because you've got cash flow from unencumbered, and because you're dealing with it across the portfolio,
no, I understand.
You have an element of robbing Peter to pay Paul.
You know, you're an exceptionally successmal investor, but there are people watching the show who may have one or two, or may want to get into it.
Yeah.
And what I'm saying, and what you're saying, I think also, but you're looking at probably more over with people with a large portfolio, is if you only got one or two, and the banking mandate changes and they go from lending 75% to 60%, which they can easily do over a 5-year period, they change, you know, banks change and so on, market changes, then you've got to make sure you're not in that trouble.
So going back to people who may be watching this with smaller portfolios, looking at building up, we're talking about leverage. What do you think about leveraging your own home? So you've got equity in your own home, you're getting a residential remortgage on it, drawing out some capital, putting it into your property business as a director's loan, and using that to do other things. That's another form of leverage. What's your view on that?
I think that's a very sensible form of leverage, as long as you can pay your mortgage.
Yes.
I think it's a very sensible form. I think it's harder to do now because a lot of these lenders are now saying, "What are you doing with the spare cash?"
It's very strange that if you tell your lender that you are going on holiday with it, they're happy. If you say you're going to build an expensive conservatory, they're happy. Yeah. But if you're going to invest in an income-generating, appreciating asset,
they don't want to know. You've got to be very careful what you're saying. Do you know in Southern Ireland, you cannot refinance your house. You can't refinance unless you can prove you're using that money, and you have to prove it on the house itself. Because they had so many problems, obviously in 2008 when he went bankrupt and all the rest of it. So, and I've had a situation where a friend of mine rang me up the other day. He said, "This is a leverage situation." He said, "I'm just pulling £250,000 out of this deal, John." And they rang me up and said, "What am I doing with the money?" The bank did, and I said, "It's none of their effing business." I said, "Well, it's a bit strong, isn't it?" He said, "Well, I'm so fed up with it." They then said they probably won't let me do it if they don't know what I'm going to spend the money on. If I'm going to buy another property and they're going to finance it, they'll do it. They'll let us have the drawdown. If not, they would talk about not letting me have the drawdown. So it's mad. In the old days, that never happened, did it? You never got asked those questions. So in these days, just be careful when you are refinancing to leverage. They may well ask you what you're going to do with the money, and you need a decent answer that keeps everyone calm. Yeah. And they don't think you're going to go and buy a brand new car with it and all the rest of it.
Yeah. I mean, actually, buying a brand new car is okay. it is actually.
Well, that's handy.
Buying a car, going on holiday.
I've just done it.
Doing all of that is fine. It is buying income-producing, appreciating assets that they'll have a problem with. But I think, I mean, that aside, you have to be. You have to tell them what they want to hear to a large extent. But the point you raised, as long as you can keep servicing that mortgage, it's fine.
I think that's very important.
And you've got to think about, well, am I making a return by taking that money, which is much more than servicing that. Yeah,
and I would say mortgage. That for most people, the loan, I mean, it's slightly different now, maybe, but the loan on the house is probably the cheapest interest rate you're going to pay. So if you're probably putting 4 or 5% or whatever it might be, 6%. If you're going to do a development, it's 12%. So, it's cheap money compared to what you're likely to have to pay on a commercial loan. So, if you take some cash out, not a bad idea at all.
Now we've talked about leverage, particularly of cash and time and assets. What we haven't really talked about is leveraging time, leveraging knowledge, leveraging of skills, leveraging of contacts, leveraging of other businesses that you've got. Leverage should be thought of in a far wider context.
Yes, because a lot of people now who get into property have been very successful in
Yes.
other businesses.
Yes.
Now,
Yes.
in the old days, that was never the case. You know, we started off as agents, estate agents, probably. You know, most of the people I know at my age who are in property never went to university, never, you know, aren't the brightest. That's why we ended up doing property, to be quite blunt about it. We started off in a estate agency and moved on and so on. But these days, there are people who have got successful businesses where they're leveraging the cash out of those businesses to then invest in property.
Yes, yes, yes.
That happens an awful lot. And of course, you know, that's a great way of doing it. And I always say to people, unless you've got at least 10 properties, keep your other business, keep your job. Don't go announcing that you're going to be a property developer or investor and bought one property. It's crazy. Keep your job until you really are very, very, what's the word I'm looking for? Stable. And you know you've got enough to do every day, because actually you do a house out, what are you going to do? Sit and watch it for the next 3 months? You know, I mean, you need to have enough going on to keep you busy. Okay, you can be a deal finder, you can leverage your time to find deals for other people, I accept that. But that's a tough game.
That
It's
is
not
a tough
easy.
game. That is a tough game. I was thinking, a great example, I think one of my students come to mind who has a trading business and has a chain of stores.
Yeah.
So the leverage comes in from leveraging the fact that he can be a tenant in his own commercial property assets. So commercial property acquisition in a SAS, in a pension fund, and then the tenant is basically the trading business. So it's about thinking, and I was working with
outside the box, really.
Exactly. I was working with a dentist who had a similar concept with a dentist practice, but the tenant is their trading business entity, but the owner is their pension. So it's thinking outside the box with how you can mix other things that you do.
Other businesses, I totally agree with that. And it's so important that you get the right advice to make sure that you're not getting any difficulty with a tax man or HMRC or whatever it might be. That advice is so important to get it right, because what you don't want to do is be unraveling it 3 years later trying to, because someone's given you duff advice or you haven't taken any advice in the first place.
If you had £5 million, probably do have £5 million, but if you've got £5 million, would you choose just to use that cash to do stuff and not leverage at all?
No.
Go on, that's the answer I expected you to say.
I would borrow, well,
because I think it's foolish just to buy cash.
Yes, totally. And that's what leverage is all about, isn't it? So
Yeah.
let me give you an example of that at the moment, okay? A live example. I won't say where it is because you'll go and buy it. So I'm not going to say that, but let me give you a live example. So at the moment, we're looking at a commercial shopping centre, which it's not a big fancy centre. It's in a market town. Some of it can go to residential, some of it can stay as commercial, but less commercial. And we can buy that for £5 million. Okay? So if I had £5 million cash, we would buy that. I'd buy it for cash. I'd then finance it 50%. So we get £2.5 million back, which we then put into another project, which was 5 million. So our 5 million becomes 10 million.
Yes.
And that's what leverage is all about. And
Exactly.
I'm using that as an example. So with this this commercial shopping centre, call it a shopping centre, you might be a bit disappointed if you saw it because it's a bit naff. But anyway, we're going to break it up. We're going to tidy up some of the rents. We're going to put them on longer leases. We're then going to leverage that, refinance that long term. And the other parts of it, which are vacant, we're going to develop for residential. So that would be a great example of leverage at a sensible rate, where we leverage to start with, then we leverage it again, and then we take out the residential element and refinance that separately and develop that and make profit on that.
Yes.
So that's almost like 3 leverages in one. So that would be a really good example of sensible leverage.
I think another way of saying what you're saying is that when you look at your return, you're looking at the return on the whole value of the deal.
Absolutely.
But
Yes.
you're putting in maybe 20% of that.
Yes.
So when you look at your total return, after you've paid off the interest
Yes.
on the rest that you're borrowing, you tend to find that your return is far more than if you put in all that cash into that deal. Your returns are less.
So, for instance,
it doesn't make sense.
No. So, say for instance, on that particular deal, £5 million, just for sake, it's worth the rent's 500,000. So it's 10% yield. 10% yield. But like you said, if you borrow half the money, then the other half of the money is a much higher yield. What's left is probably a 20% yield on your actual cash.
Yes.
And that's what you're saying, and that's absolutely right. We have to, you have to sweat your money. You have to make it work as best possible, and you have to, on the whole, make it last as long as possible in terms of what you're trying to do. So if you've got five might be 500,000, it might be 50,000, whatever. If you can chop it and halve it and do double the amount of deals than if you paid cash for it. I think 50% is fair, sensible.
We've also all got to outrun that bear called inflation. And the real inflation, I mean, you've got the headline inflation and all of that, but the real inflation is always slightly different. And I think everyone's personal inflation rates are slightly different as well. And we've got to outrun that. So you've got to be making returns in the 20s pluses, and then much higher than that if you're going to sort of compensate for the whole risk and all the rest of it.
But also, Ranjan, it's the time it takes, because you could do a residential development that in the end takes 3 years and you've made 30%. You think, well, that's not bad. Well, it's not great because it's 10% a year. Yeah. It's not great. Or you can do it, or you can do a deal that takes you a year and you make 20%. That's far better.
Yes.
So it's horses for courses. And what I like about commercial or mixed-use developments is if you've got that commercial element which is let, a lot of that rent covers your interest with the bank and everything else. Makes a massive difference. It is.
There's a lot to be said about mixed-use properties.
Do you know much about that?
Oh, a little bit here and there. I think one of the main things that I've kind of learned over the years about mixed-use is the bank's attitude to it.
Yeah.
Because commercial property does go through cycles.
Yes.
With interest rates and values and yield expectations, because it's all linked to that. And we've had some recent bank revaluations, and they've turned out to be quite okay. And the reason is that the commercial bit, although they're down a bit from 5 years ago, but the residential bits are up a little bit. So overall, it's all fine.
Yes.
But if it was just commercial, over the last 5 years, there has been
some people have taken a real bath on pure commercial.
Exactly.
Real bath where they've lost tenants. They might have had it let for say 100,000 a year, and it's a 10% yield. It's worth $1 million. Now it's only worth 50,000, and they've got a 750,000 loan on it. Well, they're in deep trouble. Yes. And we're picking up those sort of deals at less than £500,000.
And with commercial property, of course, that's why it's hard to get as much leverage as you can on residential property.
Mainly 50% leverage is the most you can really get.
Particularly these days.
Yeah.
So essentially what we're saying is that leverage in all its forms is essential if you want to succeed in this world of property.
Without question, but it's got to be sensible leverage.
Yes.
We're not saying go mad.
And it's sensible leverage at the time in the property cycle and in the market that you're dealing with, and also in relation to yourself and your stage of life.
Yeah, I agree entirely with you. Timing is everything.
Timing is everything, and that is about all we've got time for as well.
What a great link. You're nearly professional, Ranjan, you are. Notice I said
enough of these.
Nearly.
Well, I like that because there should always be room for improvement. So if you've got any points for us to improve on, do comment below. Catch us in the next episode. Don't forget to like and subscribe for more of these videos. See you guys next time. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.